Well, you've made it. This is the last chapter. Congratulations. I know this has been hard. I know it's a lot of material, but you have made it. So hang in there with me for one more chapter. This is usually a chapter that students find pretty interesting. As always, you want to make sure you have your notes, you have your calculator and your pencil handy so that you can really engage with the content, work the problems with me as we go along. So we're going to be talking about capital investments. Now notice this is capital with an AL, not an OL like Austin and Washington, D.C. So we're talking about buying really big, expensive assets, assets that we're going to use for a long time in our business. So these are things like equipment, machinery, expanding our operations, vehicles, opening new plants, things like that. So obviously we have to plan for these. So a capital asset is again that asset that we're going to use for a long period of time in the business. Typically it's pretty expensive. Um, when you were taking financial accounting or accounting 2301, we called these property, plant, and equipment. They're in that long-term asset section. These are all the assets that get depreciated. Now, the capital investment is the act of buying this asset, of investing in this piece of equipment or this vehicle or whatever. And so capital budgeting is just the process of planning to buy that. I don't know about you, but when I need to buy a new car, I have to plan for it. I don't just wake up one morning and be like, ha, I'm going to buy a car and then go down the dealership and, write a check or hand my um, credit card over. I have to plan for that. So this is helping us plan to buy those assets. So our capital budgeting process, first of all, we've developed our strategy. Remember, our strategies are those long-term goals. So we've identified now some potential capital investments that are going to help us get to those goals. So maybe we've identified, hey, we need to buy a new car. We need to buy a company vehicle. So first of all, we're going to identify the potential capital investments. So we're going to identify all of the different vehicles that would meet our needs. We're going to apply capital rationing, which says I have X number of dollars to spend, and anything over that is automatically off the list, right? So if I'm going to buy a car, maybe I say, hey, I've got $40,000 to spend, and anything that's over 45,000, well, that's off the list. I can't afford it. And then for the rest of the capital investment procedures, we're going to analyze them, which is what we're going to spend the bulk of this chapter on. Then acquire those capital investments. So go through it, buy the asset, use it, and then we'll perform what we call post audits. So this is at the end, looking back and say, all right, what did I do well? What do I know now that I would do differently next time? So again, capital rationing is that process of knocking out all of the ones that we just can't afford. We have a limited availability of funds, so let's just go ahead and cut off the top, the Ferraris, the Porsches, all of those that we just can't afford. And then that post audit is comparing our actual results with what really happened and learning from that so that we'll do it better next time. So there are four different methods, popular methods. There's really a lot more than four, but four main methods for analyzing capital investments. And we're going to look through all four of them over the next few videos. So the first stage of capital budgeting is that we want to screen the investments using a method that does not incorporate the time value of money. And we'll talk about what that means in a little bit. And then for all investments that pass that step, we'll analyze them further using methods that do incorporate the time value of money. Now, traditionally, GAAP accounting, generally accepted accounting principles, is based on accrual accounting, which means we record revenue when it is earned, we record expenses when they are incurred. Capital budgeting, however, focuses on cash flows primarily. We'll talk about a few exceptions to that in a minute. So when we're talking about cash flows, we're going to treat cash flows as any revenue that the investment generates, any savings that the investment would cause us to have. So for example, maybe your new car, it gets better gas mileage than your old car, so that cost savings we'll treat as an inflow. And then the residual value at the end of the useful life. So remember, residual value, salvage value, trade-in value, resale value, that's how much we expect to get for the asset at the end of its useful life. That's always an inflow. Our cash outflows are those initial investment, that acquisition cost, also called a down payment, if you will. Any additional operating costs that we would have, so maybe the insurance on our new car is going to be more than the old car, so that additional cost is a cash outflow. And also take into account any refurbishment, repairs, maintenance that we are expecting to have to do on this. So when we look at our life cycle of capital investments, so we're going to acquire or buy the asset on what we call time zero. So this is a finance term, and for those of you that go on to the university and take some upper level finance classes, you'll talk about this a lot more. So this is time zero, or year zero even, is when we buy the asset. It's theoretically today. And then we're going to use the asset, and we'll have inflows and outflows as we go along. And then at the end of the useful life is when we will dispose of the asset, and then we'll get that residual value inflow.